Thank you for joining us on this lovely summer day. Thought it was a good time to have this topic. Dave and I were joking about the last time we did this, and this feels similar. So anyways, I'll go ahead and turn it over to Dave, but remember you can chat by clicking the little chat feature, raise your hand, we'll unmute you and you can ask the question live. Oh, Dave, you're muted. Hold on one sec. Now you're good.
Hello, how did that happen?
I'm not sure.
I don't know, I pushed the wrong buttons. Really,
There you
that's
go.
weird. That's so weird for me. All right, welcome everybody. Hey, thanks for tuning in. I wanted to kind of, we've been talking about this and what brought this particular topic up was we were looking through an old file. And just a fun thing where you kind of look back at some of the newsletters we wrote years and years ago. In this case, it was 20 years ago. And it popped up and it reminded us of a meeting that we did that was called Get Ready for the Bull. And that was actually in the fall of 2002. And by complete luck, and I do mean this, it's not like we can call market bottoms. This was like a week before the market bottom that we did this meeting. And it just reminded us that we really need to be talking about this peak of pessimism, as John Templeton and many others have talked about over the years. That's exactly what the market needs, is kind of this washed out feeling that it can't ever get better. And we'll talk about some of the things that they're talking about in the news, but you know, in more depth, but you know what they are, because all you have to do is turn on the news, listen to the radio. It's all doom and gloom all day long. It's never going to get better. And Joe's not in control and it's falling apart. It's just reading the Wall Street Journal today, talking about that. Even the networks, which are, you know, far left wing, CNN, MSNBC, are turning on Joe Biden. And so this has really become the circumstance where Democrats don't know what to do heading into the midterms. They're abandoning ship. Well, imagine what independents and the rest have feeling about leadership or the lack thereof. And so it's not just a difference of policy, it's a feeling that there's no confidence, right? It reminds people of the 1970s and Jimmy Carter going over and turning down the dial, right? And telling you it was going to be a long winter and really bad, okay? That's not how we want to feel like. We want to be that feeling that we have and can trust in our leaders to be moving us forward. Not that we want answers for anything at all out of Washington, D.C., but not this lack of leadership, or if you will, misdirection. Because there are so many things out there when we talk about energy policy and things like that. I don't want to jump in the weeds here, but this is what you'd have to say is the peak of pessimism. I mean, it really is. And it wasn't because we're calling the bottom of the market. That's not what I'm saying. I'm saying that this is what market bottoms look like. It doesn't mean it works every time, and it doesn't make it an exact process. It's a process that you go through where it just simply can't get any better, and so it does. And the average market turnaround from a bear market, and we're in a bear market, right? We're already down 20, is 45% from the bottom in 90 days. 45% in 90 days. Averages don't matter because some are more, some are less, and they just go crazy. But it's right in that 40% range at the average turnaround within 90 days. They move fast, and you just really have to catch them, because as we've pointed out many times before, the best market days are right next to the worst market days. And if you miss the bottom or the best 10 market days over the last 10 or 20 years, your return is zero or near zero. It's worse than inflation. And I don't mean current inflation. I mean past inflation when it was only 2 or 3%. It's just terrible. So we can't miss those good days, and you can't time it to get in and out. I know there's people that proclaim that, but you know, that just doesn't work. It never has worked consistently. So let's start with what some of the worries are today, other than just talking about energy, it's inflation. But let's go ahead and start by looking at some hard data, if you will, okay? So as you're going to see here, what we want to understand is, why are we having inflation? Obviously, it's Putin, it's everybody but us, it's all those things, but we know better than that. And the average American does too. It's not that. It's that we went ahead and injected a ton of money in 2020, and then we just kept going. The money supply and where the Federal Reserve really blew it is, in fact, by not pulling back this money sooner. And they should have. I have no idea. I've said this before. I have no clue why, when they knew that inflation was not transitory, why they kept digging the hole deeper, but they did. And you can see that here. But that is the key. And we're hoping that this blue line is leveling off and then heading south. How do you do that without killing the economy? Well, good luck to the Fed. And I don't mean to be negative about it, but it is really not something that I have a lot of confidence that they're not going to have us in a slowdown. Now, let me take a moment to talk about that, though. The slowdown is not something I'm saying there's going to be a recession. There's absolutely nothing out there that indicates a normal recession. There really isn't. We're slowing down from accelerated growth. So could we be at zero growth or slight positive or a slight negative? Maybe even it's a technical recession. I really don't care if we're down 0.5% over a 2-quarter period. So technically, we had a recession. That's how they measure a recession. But look at the jobs numbers. We're creating jobs. If you want a job, you can have it. People are competing for workers. We are too. It's all, everybody wants qualified people. It's just a fact of life we're living in right now. That would be a pretty weird recession. The economy is so bad, but jobs are plentiful. That has never been seen before. And that's the key, is that jobs are so plentiful. Plus, supply chains will solve problems. We're reopening still, all of those things. And yes, consumer debt's increasing, all these other problems are there. That's all true. But all this comes together to say slower growth is still slower growth. But it is growth. That appears to be where we're at. But are they going to be able to stop it from going from this higher growth that we ought to be on a 4 or 5% growth rate coming off of the shutdown, where we were before, by the way, and not get us back to zero? I doubt it. I doubt it. So I don't think it's going to be big boom times ahead. So let's look at some of the other things like earnings. But let me start here, though. That's a good point. Let's start here with the components of inflation and why I am not as concerned, and many economists are not concerned about long-term inflation. Okay, energy is where you see these are the components that are contributing right now to where inflation is, and the top 3: energy, new and used vehicles, food at home. Those are all the top parts, and those are transitory. Maybe, right? Those are the kinds of things that, hey, high prices solve the high price problem. They always do, right? So we drive less. The economy slows down. We figure out more ways to drill holes. I get it. This is one of the most frustrating things about this administration, and if you will, the tone-deaf nature, that they scream and yell at oil companies and then try to run them out of business. They want them to drill new wells, but then they take the permits away. None of this makes sense, but the rest of the world is going to go ahead and make money drilling holes in the ground, and that is the global supply. So that will be met as we move forward. So, and if we're talking about $100 a barrel oil, to have the kind of push that it had to go forward, it would have to go to 150 and higher. So the point is that part of the inflation, we're not going back to $40 a barrel oil. Nobody thinks that's going to happen anytime soon. But actually just not going up much or even pulling back slightly here means it adds zero to that, right? So suddenly inflation looks a lot better. New and used vehicles, I'll just quickly say this. The Wall Street Journal last week reported that General Motors, just for the quarter, has 100,000 completed vehicles sitting there waiting for one thing. I know you're jumping ahead of me. A chip. One company with 100,000 completed vehicles. Those chips are coming. I think you can take that completely out of the picture. I'll show you some fun stuff later on today, but to think about the fact of inflation being added to by new and used vehicles is a new occurrence right now. I believe that's transitory, and I think the numbers show that. Food, obviously, we're going to grow more. That's going to happen. We're going to have supply chain issues with Ukraine and on and on. That will resolve itself. I believe that will shrink as well. Now, are we stuck with some things? I think so. Let's go all the way to the bottom here. And that is down here in the dark blue. When we think about shelter, which is 40% of CPI, it's going to keep going up. There's no question about it. It has lagged inflation, partly because during the pandemic, they couldn't raise rates for rentals, and now they're catching up. And they're catching up big time. There's nobody out there that isn't aware of how much rents are going up. What do you mean, $2,000 for an apartment with a 2-bedroom apartment? Are you kidding me? Totally normal in Boise, Idaho. So this is not luxury apartments. This is just normal apartments. Is that going higher? Absolutely, in my mind. So there's some give and take in this, but that's why I believe that we are seeing peak inflation. Not going back to 2 or 3%. It will be persistently higher, but are we peaking? We are, in my opinion, okay? And I'm not alone on that, so I'm not gonna pretend that I have some kind of lone wolf thought process on that. So that's helpful to think about. It's never gonna get better. Everybody's talking about this. The discussion on inflation could hardly be worse. And I think there's reasons to think that it could be peaking. So let's go on and let's look at some more things. This right here, as you'll see, is really talking about interest rates and inflation. And one of the reasons that I'm pretty optimistic about stocks is, one, they actually do very well in mild inflationary environments, not hyperinflation, all those things. We all point to the 1970s, stagflation. We can still have it. I'm not saying any of this is etched in stone or this is the way it's going to be. What I'm saying is, why would you buy a bond at 2.9% so you can lose at least 3% a year in real terms? It doesn't make any sense. People will continue to rotate out of bonds, in my opinion. Once again, are they going to be in cash and earn 0? Are they going to be in bonds and earn 2.9 in a rising interest rate environment and earn 2.9, which is below the rate of inflation? Or take the risk of the market, which now offers yields, and they're growing, of 3%, 4%, and 5% dividend yields. These are very high on high quality companies with impeccable balance sheets, is, I think, going to continue to attract capital in that direction. Let's go to the next slide. Now, the other buzz you're hearing out there is, and this got so loud, I mean so loud out there for probably about 2 months ago, and it's just been constant. And over the last month has amped up, and now I think they're finally shutting up because none of the companies have changed their numbers. So, and the analysts are way too high on their estimates. The earnings numbers have to come down. They have to come down. They have to come down. In other words, you see that chart that shows that actually the valuations aren't above average. They're saying that's because the estimates are too high, okay? But they've been screaming about that for ages now. Another reason why I think we're at the peak of pessimism. Earnings can't possibly keep up, but companies aren't cutting their earnings estimates. All of these things, stocks are so overpriced. They've been saying that since the Dow was at 10,000, by the way. It's all of these things kind of coming together that we're acting like we're stuck in this environment where corporations will not be able to adjust. Yeah, we had a good day today in the market. That's grand. That's glorious. But what is interesting about it is that the very companies that everybody's saying can't do what they've been doing are the market leaders the last couple of weeks. And they're the market leaders for a really good reason, in my opinion. Google at 14 times earnings. Yeah, but they're not going to have ad spends. You know what companies are going to do? They may cut back on ad spends, but maybe they're not going to buy a billboard that doesn't work. Maybe they're not going to blanket the TVs with ads that isn't as effective. But do you really think that they're not going to be giving Google as much money down the road when it is the most effective advertising dollars that you spend? To me, it's ludicrous. It's just throwing the baby out with the bathwater. And those prices have come down and they're growing like crazy. And besides, Google has about 10 multi-billion-dollar businesses that they just aren't even profitable at this time, right? They're so far ahead of everybody else in autonomous cars, as an example. It's crazy, all the different things, but what people do is pile on, and they have this constant sound, right? You know, it's like watching CNBC some mornings. It's like, oh, it's never going to get better. It just won't get better. Never going to get better. I mean, it's just this constant doom and gloom, and all they do is parrot each other. Because hardly ever do you see somebody come on and go, yeah, I like the market here. When I can buy Amazon off 35% from its highs, I'm a buyer. Maybe it goes down, it's down 40, but I'm a buyer when things like that happen with high quality companies. It's rare, but that's exactly how all of the greats of all time have invested. And that's what we believe works consistently, is to just stay invested in the highest quality companies. All right, let's go back and look at some better news, if you will, okay? This is a stunning, if you want the best chart that I can tell you in the whole wide world, show you in the whole wide world about how wrong people are all the time. Okay, consumer confidence can't get, they're not going to spend money. Nobody's going to spend money like ever again, because consumer confidence is where it's at an all-time low. That's right. I don't care if you're on the left, you're on the right. Nobody thinks that this country is on the right track. I mean, almost nobody. I don't even know people that know somebody that thinks they are, that this is the way we ought to be going, right? People are not happy. They're not confident about the future. And this is what the market returns are. If you look at the box up at the top, when we are at peaks of the consumer going, happy days are here again. The sky is so blue. You got to wear shades. It's just unbelievable. It's so happy out there. Market returns are 4%. Very low. And when people are down, I don't even want to tell you this number, but you can read it. It's 25%. We're at the all-time low. All-time low. And as you see the numbers from all these peaks, the worst is 14% over the next 12 months. That's crazy. I mean, I'm not saying over the next 12 months, we are going to go up 14% or 24%. I don't know. I just know that the peak of pessimism looks exactly like this. And there's nothing that I know of that measures a peak of pessimism better than consumer confidence at all-time lows. Doesn't mean the market rips higher. This is not a trading thought process. It's just saying, could we be nearer the bottom? I don't know. It seems like it. It feels like it. And looking at historic data, it really looks like it. And I know statistics lie, liars use statistics. We can carve these things up and do all kinds of great things with it, just to show you, to make my point. It always is true. And we always guard against that. I totally get it. It's just one of those things that this is one of those that intuitively that the herd is wrong most of the time. If that's the case, I want to not just feel that that's the case, I want to measure it. And consumer confidence is a pretty good measure of that. On the other hand, I'm going to say that business confidence is also at a remarkably low level. And that is not good. That is not good, because those are the job creators of the world. And if you're not confident, you're hanging on to your money, you're not expanding. If you can't find workers, you can't expand. If inflation is out of control, you can't afford to continue. So these are the things that are concerned. It's not a perfect environment. It's not that the skies are clear. It's the clouds are so thick that it's hard to imagine a lot worse happening. It always can. It can always get worse. But there are times where we have to step up and go, you know, odds are we're somewhere near the bottom. The valuations are looking pretty good. You can buy great corporations with pristine balance sheets that raise their dividends like every year for 40 years, 50 years, 60 years at ridiculous levels. Our income portfolios just had a huge yield rally, right? The valuations went down. The dividends have been going up. Where are the dividends on the portfolios from a year ago? They're higher all across the board, including the S&P 500. Dividends are at all-time highs. Corporate profits are at all-time highs. That's what the reality is. We're not buying this thing called the market. We're buying companies, the greatest businesses in the world, the innovators, the creators of all the stuff we love. And maybe you don't love it. That's fine. Maybe you don't like Apple's iPhone. I think it's great. But I do like what the company does. And it raises its dividends massively every year. So I don't think that's stopping. And that's one of the reasons you look at it, you look at the valuations, and you also have to come back to this. Market corrections are normal. They happen all the time. When it's 20% or greater, which this one is a bear market, occurs about every 5.2 years. So 5 years. We have one. So now let's take a look at some other little happier notes, okay? These are some of the price changes that I just thought this was interesting. I thought you all would find this super interesting. We all know TVs cost nothing anymore, right? But this is clear back from 2000, so it's 22 years of price changes in consumer goods, services, and wages, okay? So inflation is not a uniform thing, like we're at a 4% inflation world. Right now it is, everything's up, okay? And that you can kind of see as you look at new vehicles down there, right down at the bottom. You see that green one right there? It kind of shoots up over the last couple of years. Thank you, Jennifer, for that note. Look at that though. Can you imagine a new car actually not going up in price for 20 years? I find that unbelievable. They're better, they're safer, they go further on a tank of gas or a tank of whatever, right? I mean, they're better in every single way. You can drive one 200,000 miles now. You don't have to change the engine like when I was a kid, every 50,000 miles. And they're practically free compared to what they were 20 years ago relative to earnings. It's amazing. And so all we see that when we see that in the inflation and we talk about how much more new vehicles are adding to the CPI, that's a new phenomena. I have to believe it's going back to where the green line ran for 20 years, right? It just has to. I don't know how this is possible to go make shoes. I'm not beating up on women here, but everybody buys a bunch of shoes for the same price they were 20 years ago. Seriously? Purses, apparel, shirts, for the same price as 20 years ago? It doesn't make any sense. Appliances are lower. Cell phones, forget about it. We all know that, and computers and all that good stuff. We got it. But look at what real wages have done over that time. They're up 100%. That's awesome. No wonder we're all rich. These are the trends that I think you see falling back into place. And you know what I also see? This is just me thinking out of the box here a little bit. Do you really think that colleges giving an inferior education over the years is going to be able to continue to charge what they charge? Or do you think there's going to be some online alternatives? Or CWI with the great work they're doing out there, driving costs down, right? It's incredible. Medical, we all get that. The components are interesting to me, and we're in an interesting time. And I just thought you'd find that fascinating, but I was stunned when to think about that on new vehicles. I just didn't think about it. It's amazing. Haven't gone up in 20 years. Incredible. All right, finally. You know, this is just something I think we have to sometimes reflect on. we always win. This is like the worst measurement period in like, I think in all of history, right? Pretty much. I mean, I suppose we could do a 2000 through 09 first quarter period when the market got whacked with 250% corrections right there top to bottom. But in 2007, we hit a market peak in November of 2007. Okay. So measuring from 2000 all the way through the 08, 09, horrifying 50% drop, great recession. And now we're measuring again from a few days ago to the market bottom now. Hopefully the market bottom. I don't know. I'm not making a prediction here. I'm just saying it's worse than it is, say, today. That's where we are. That's where we are. If you say, I've asked this question, well, what about gold, and inflation and all? Well, how's that looking there? Not very good. Not very good. Particularly now when you think of all the tailwinds gold has. I have no idea why it won't move, but it won't. Stocks always win. They always win. And when you're buying them 20% down, they always win. It's a crazy, crazy thing. And sometimes it's hard to remember that. I get it. I get it. All right. I think that's it. That's all I really wanted to say. So peak of pessimism, maybe it gets worse. There's always things that can go wrong. There always are. But in the meantime, I like to think about it statistically. We're at a good spot to be thinking about investments, adding to them, all those things. And also, I'm going to leave you with this thought too, because this is so true about investors. I don't care if it's $5,000. Put it in your account. Invest. Why? It changes the whole reality of your investments. It really does. I know people have been holding cash. We see the balance sheets across the country. I don't mean all of you, but there's some of you that are holding a pile of cash. I don't care what the amount is. When you invest into downturns, it's not just that you make a ton more money. I think that goes without saying, right? But it changes psychologically you. You don't fear the downturns as much down the road. It looks more like opportunity, which of course it is. It is. It's an opportunity, for example, in some of the companies we talked about, to have 30% more yield for free. 30%. You just increased your income by 30% for the rest of your life. Now that's kind of cool. It really is when we start changing that dynamic, but you can't if you just sit back and go, oh, I'm just going to take the beating. I don't care if it's $5,000. It changes you psychologically to invest in times like that. So think about doing that. I really think you should. Okay. Jen, let's open up for questions. Okay.
All right. As a reminder, you can chat down in the bottom of the screen and I'll just read off the questions, but it looks like we have, let me unmute you here, Mike. Go ahead.
Okay. Hi, Dave. Hi, Jennifer.
Hi.
Thanks for having the Zoom call. I hope you can hear me okay. I'm in my car. I'm not driving. I'm just in my car.
Okay.
Question.
Hopefully your wife will let you back in the house soon, Mike.
Yeah. Are you taking advantage of some of the funds that are historically low right now? And one in particular that I have a question about, Intel. Intel's down about 40% from its peak. It's paying about a 4%, a dividend at this time. That looks like a pretty attractive stock to buy. Are you looking at that, moving funds around to take advantage of that?
There's some of that, yes. And of course, with some of the funds that we have, you're going to see this. Now, everybody's different, okay? So it's not like everybody owns the same stuff out there because everybody has different objectives, right? And so I'm just going to give a classic example of two things that a lot of people own, okay? One is that is the Franklin Income Fund. And so when we were at a higher price level. We turned the income, the dividends, which are monthly and very high, into cash. We just let it come into the accounts. And when it got up to, I don't want to get in the weeds, just a much higher level here that it did at the end of the year, we began trimming those positions, okay? We didn't get rid of them, but we trimmed them. Now prices have pulled back. Many people will start seeing those dividends reinvested. Why? Because we're compounding those shares that produce income every month, all the days of our lives. We're going to be able to compound those at more than 10% higher than we were just 6 months ago. Okay, so it really adds up and feeds the income. And we do that also with several other holdings when they fall. And that one was, for example, most everybody on this call has some private real estate, which is really through a mutual fund. Okay, I don't want to get too far in the weeds here, but they have those, and we've been reinvesting dividends on and off. And this right here these are actually up year to date in a bad market. So those are holdings that almost everybody has, at least unless you're in a pure growth portfolio, you would own some of that. And that's because it's a stabilizing factor in the portfolios. We're not yet pulling money out of those to go out and buy more stocks. There's two reasons for that. There's still a lot of uncertainty out there. I don't need to tell you that. But the second part of that is that also for people right now, the most important thing is how we behave. I can go do that in my portfolio. Jennifer can do that in her portfolio. But we have to think about, I have 40 years experience. Jennifer has 30. Okay, this is not where people are. And you may be an 80-year-old investor. That's not what I'm saying. But you don't do this every day. You don't live the downturns every day. It just simply hurts. So we want some stabilizing things in here because it is all about our behavior as to how much money we have at the end of the day. It's not picking all the perfect investments. It's staying with them and making minor adjustments, not all or none, not thinking we got this. So most people are going to continue to see those help. But in our growth portfolios, those positions are coming down and we're starting to add to stocks. So Mike, these are smaller things around the edges. You're going to continue to see that depending on market conditions. But we are making some changes out there and you will not see a ton of them. That's not us. If a stock is down, it doesn't mean we ditch it. It doesn't mean we add to it. It might mean we ditch it because everything changed. But what we want to do is make sure when things that we feel are high quality are down, we're at the very least reinvesting dividends and maybe beginning to increase allocations. Hopefully that answers the question. And as far as
that does, Dave.
Okay, good. Individual stocks are individual, and obviously Intel has got a lot of problems. That's why their stock price reflects it, because everybody knows they're way behind the curve.
Yeah, that was just an example. I'm not going to chase it either, but okay, great. I know we're going to climb out of this, so we'll just give it some time.
Good.
Thanks.
Good. Thank you.
Any other
Anything
questions?
else?
Chat with us. Raise your hand. All right, Dave, I'm not seeing anything else. If you want to wrap up, I'll keep my eye on it.
Perfect. Look, again, I don't think this is necessarily a market bottom. Maybe I kind of do. Maybe I kind of hope it is, because the peak of pessimism just kind of sneaks up on you. It doesn't mean we're going to rocket higher. It just means to me that the odds are better. And one of the examples that we decided not to put in today, I'm just going to quickly talk about, because these are the things that really happen in these environments and why we really encourage people to invest into them, and because it helps them understand better. But we are just absolutely mystified at how when something is off 20%, and so demonstrably it's off 20%, it's 20% less risky, right? I mean, it's down 20%. It's, assuming it's not, the market doesn't go down 100%. And if it does, I don't know. I don't care where you have your money, it's gone. It doesn't really matter if it's cash under your mattress, it's worth zero. So we're going to make the assumption, the wild assumption, that the market doesn't go to zero. And so we're already down 20%. So we all know from statistics and number, that's probably a fair amount. It can go lower, but where we are 3 years and 5 years out from here, almost always is way higher. I mean, way higher. And even if it did dip a little bit lower, it's a great time to invest. Now, saying that, okay, yeah, in the abstract, that's true. But what's really weird about it is that we also have tremendous volatility during those times, and it's completely contrary. But some of the things that we use that have little hedges on them, and again, I don't want to get too far in the weeds, but here's the bottom line. When you hedge something, you cap the upside. It's really about that simple, okay? So these things that come out, they're exchange traded funds that offer 10% ongoing downside protection. 6 months ago, that capped it at 10. Today, it's 22%. Same downside protection, twice as much upside. It makes no sense. None. You get the same downside protection, which I would already argue is even more because we're already down 20. So the odds of going down more than 30 begin to diminish. And yet I have twice the upside. It's really an interesting thought. And it's interesting when we think about it from income. And this is why we tell people, really think about it from an income perspective. Come into this and think about a company like Simon Property Group. Okay, I only use them as an example, who had a yield rally of 40%. Their stock was over $150 a share. It's now below 100 because they're in shopping malls and nobody will ever shop again. Amazon's going to drop all your packages in your pool, and that's the end of all shopping. Okay, well, if it is, then I think they'll turn those places into condos, data centers, and et cetera. And it's the same company that paid a dividend all the way through the pandemic. Okay, I'm not telling you to go buy Simon Property Group. I'm saying now I get 7% yields. I got 5 before. I want 7. I'd rather have 7. And what we're doing is reinvesting. Either way, you're putting more cash back to work at better yields. These are the kinds of things across the board that get us excited about the future, because if we move into it, not guessing bottoms, but allowing them to occur and with reinvestment, not worrying about catching the bottom. Nobody ever gets the bottom trade. Nobody. It's not available. Get over it. You're not a loser because you bought ABC company down 30% and it went down 35 and then went up 50 over the next few years. That's called a winner. But you know what you feel like when it goes from 30 to 35? Loser. That's what everybody feels like because it's human nature. It's insane, but we get this all backwards. We really do. Anyway, I just wanted to close with those thoughts. This is an interesting time, and volatility, who everybody hates, man, it's just such a friendly investment environment. It's hard to wrap our minds around it, but opportunities are better when it's volatile like this. Thanks for joining us, everybody. And do we have a quick question here?
I think we're okay, Dave. I responded
Good.
back.
Okay,
Yeah, we're good.
So.
All right.
All right. Have a great rest of the day. Thank you again for being our clients, and we'll look forward to our next one.